Sound.
That was beautiful.
Thank you, Danielle. Thank you so much for those who joining you now. For those of us joining us now, this was Danielle Dalarossa playing Chorinho. He's gonna come back at the break. Obrigada, Danielle.
Sure. See you on.
Thank you all and welcome to BayBrazil Annual Conference number 9. This edition is a special one to us because June marks BayBrazil's 10th anniversary. To celebrate, from today until September 10, we'll present weekly online events focused on a variety of topics. Today, we will be talking about the US and Brazil economies. It's no coincidence that our speakers will recap 10 years of innovation in these two regions. So much has happened, so much disruption has happened in the tech sector, and we have a very special group of speakers joining us right now. I want to start by introducing our moderator, BayBrazil board member, and Tsao, managing director of Silicon Valley Bank. Hey, Andy, number 9, here we go.
Oi, Marguerite, amazing. Congratulations. Obrigado, Marguerite. So again, my name is Andy Tsao, and I'm a managing director at Silicon Valley Bank when I'm not a BayBrazil board member. And I lead a business at the bank that we call our Global Gateway. And we that's a team that does business development in new and emerging tech hubs around the world. And in fact, the very first market that we spent time in was Brazil. So it's not, and that was in 2012. So it's not quite a decade, almost, but in keeping with celebrating 10 years for BayBrazil. And again, congrats, Marguerite and BayBrazil for doing what you do in building bridges between the Bay Area and Brazil. I'm delighted to be the host for the first event of the Brazilian 21st Century Conference. We're kind of spreading it out this year, given where we are with live events. Unfortunately, we can't get together, as we know. And so again, the topic today is going to be looking at venture capital in the lens of BayBrazil's decade. We're going to look at it in sort of 10-year increments. And let me share my screen with you. Let's see. Sorry about that. How's that? That coming out okay? Okay, terrific. So, I want to go over our program today. So it's really a 2-hour program, and I know that's a little bit long for webinars, but we've really broken it into 2 segments. So feel free to, we'd love for you to stay throughout, but the first hour is going to be, which we're already into, is going to be looking at the U.S. market, and we'll have a keynote, a panel discussion, and then leave a little bit of time for Q&A. Then we'll transition at the top of the hour to the same thing, looking at venture capital in Brazil over the decade. And I want to quickly run through and thank and introduce our speakers here on the right side of the screen. And Steve, forgive me for your the insertion of you a little bit late, but on the right side we have Iris Choi from Floodgate, and Steve Schlenker from Dan Capital, and Nick Candy, my colleague from Silicon Valley Bank. And then on the left side of the screen is our Brazilian panel, who will be joining us in the second hour. Anderson Thies, Eric Asher, Nicolas Szekasy. For those of you who follow Latin American venture capital, they really need no introduction. So with that, I'm going to turn it over to my colleague Nick, who's going to be giving us a presentation from Silicon Valley Bank's State of the Market report. And I'm going to stop sharing now. Over to you, Nick.
Cool. Thank you, Andy, and welcome everybody. It's nice to be here. So I'm going to share my presentation. Hopefully you'll be able to see it now-ish. Let me just change some of these settings. So hopefully you can see the full screen, the full slide. Excellent. So yeah, very quick, just because we are running a little bit behind. My name's Nick Candy. I work at Silicon Valley Bank, head of research, and part of our group's work that we do is we produce this quarterly report called State of the Markets, which goes into all things innovation economy globally. And so the last report came out a few months ago now, and I've taken a few slides from that, which I think are particularly relevant to this audience. There's a lot to cover, and the report has even more slides than this, so I'll go as quick as I can and just kind of bring out the key takeaways from each slide. So maybe just some quick level setting here and a bit of a macro slide, but obviously we're in fairly unprecedented times with COVID, shelter in place, economic slowdown coming from that. And so this slide basically outlines some of the estimates that we're seeing across the globe for GDP. Obviously, the US is now officially in a recession. You've got the UK, Japan, and of course, lots of South America who have officially entered recession. But it's not all bad news, especially if you're in tech. So we did enter a bear market especially quickly, such was the suddenness of the COVID-19 impact. But even through bear markets, tech in general does pretty well. And so even when we're in bear markets, tech tends to outperform the broader market. And also coming out of a recession or out of a bear market, tech also does especially well, especially in this environment. We've seen tech outperform, things such as shelter in place has made it a necessity to work from home, and then you've got a lot of the applications which are tech-based, which is accommodating that. Taking a look back, obviously we were at the end of a decade, so taking a look back at the prior decade, and it's really been one which has been pretty pronounced for venture capital in general. We've seen a marked run up in the amount of capital and number of deals taking place, really peaking in 2018, globally raising record amounts like over 300 billion, which is a substantial amount. As you can see, this has been pretty well shared recently between the US and Asia, and obviously Europe and the rest of the world is growing as well. But certainly the emergence of Asia has been a big story here. And even for 2020, when we look at the numbers to date and try and project that out, it's not all doom and gloom. At least on prior estimates, it looks like we might be on par for 2020 in terms of venture capital deployment. But then having said that, these numbers are slightly dated. So if we take into account some of the backlog of deals that have since been complete and net new deals, be interesting to see how this trend emerges throughout the rest of the year. One thing that's definitely happened to VC is this growth in sheer size. We've seen mega funds, we've seen mega deals, we've seen the announcement and the spread of unicorn companies, which have achieved valuations over $1 billion. And that's really pronounced in the deals by stage. We've seen a 14x increase, or we're expecting to see a 14x increase in the number of deals over $500 million, which going back 10 years ago was just unheard of. And like I said as well, Asia has really emerged as a key region now in terms of the growth in venture. And once again, looking back at this decade, we've been in this bull market we were in a bull market for such a long time. And, most people in their professional careers, certainly myself, can't really remember a time when we had a real bad period. Obviously, global financial crisis was over 10 years ago now. And so one thing we wanted to focus on is how many firms, how many VCs have actually been through a recession, a down period. And so we broke that out by the size of the funds. We also looked at the current crop of VC-backed companies, and overwhelmingly, a lot of firms and companies have never experienced a recession. Maybe not so surprising, but once again, it just shows that we've had a brilliant run up, and now is going to be a high period of uncertainty for a lot of these firms and companies. And experience does pay. So you can see from the bottom chart, the returns for funds that have gone through prior recessions are fairly the same, but the ones who were founded before the dot-com bust, for instance, versus after it, there's a lot smaller range in terms of the returns that they're getting, which just shows as a group that cohort performed better, and it's telling that that was the more experienced group, and we've equated that to the returns that they've got. One thing to caveat what I've just said is, obviously people move firms and take that experience with them. So there's that nuance to this analysis, but our belief is generally the firm's culture, its network, its deal flow, its processes, they're big determinants of success, and that typically stays with the firm, with the firm and its people and the funds it administers, and hence that's what's showing here in these results. I really love this slide, and it's really exciting for me, and I'll quickly touch on the key theme of it. And it's basically, when you have these down periods, the dot-com, the global financial crisis, it's not all doom and gloom. Periods of uncertainty actually drives innovation. And so what we're seeing here is that when we've been through these periods, unemployment has spiked, but what that has done is led to an increase in company formation. Some of the reasons for this is there's obviously a low opportunity cost to not having a job and trying to find a new job versus start something on your own. And especially nowadays, with the cost of starting a startup being much lower than it was before, and with unemployment reaching 13–14% in the US, we are expecting, and we're encouraged, that we'll see a spike in company formation, which is obviously really good for the innovation economy in general. And you also get some of the best of breed companies out of these periods. The dot-com crash had Facebook, it had Tesla, it had DocuSign, Salesforce. The global financial crisis produced Pinterest and Uber and Slack, for instance. And one thing that's really interesting is that the majority of these companies are founded by people who've got prior big tech experience. And we've all seen the layoffs that have happened for startups and for big tech. And that's a real qualified pool of people that could turn their hand to entrepreneurship and create companies, and once again, spur the next phase of innovation. Obviously, the pandemic has made us all change our behaviors, and albeit the deal flows that we're seeing are somewhat lagged, we wanted to understand what are some of these emerging industries that are taking place. So we looked at some Google Trends analysis and then parlayed this into conversations we've had with venture capitalists, and as you can see, a lot of those sectors that are getting the interest are very tied to work from home, COVID-19 pandemic, etc. So we're seeing a big upticks in remote work, food delivery, alternative care. So think telehealth, for instance, remote learning. In general, corporate America is looking at more digitization, more automation. So we expect those sectors, areas to also garner a lot of interest in the near future. And we're hearing it anecdotally as well. It just hasn't quite shown up in the numbers yet, but we expect to see that in a not too distant future. So this is an interesting slide, and this is partly, we were partly able to create this due to SVB's somewhat unique position in the ecosystem. We obviously bank a lot of the startup community, and from that, we get a lot of information, a lot of insight. And this is one of the things that we can produce. So you can see that we've demonstrated the cash runway of various different sectors. And there's a really broad range here, which I found particularly interesting, ranging from 4 months for professional service companies up to 17 months for payments. This might look differently now. We've had the PPP program, which has provided some relief and some extra liquidity. Also, this was at a time when companies weren't as fierce in cost cutting to ensure they do have that runway. You can certainly see from the bottom chart as why having a good runway is important here. Generally 12 to 18 months was the rule of thumb. But as we can see, that wouldn't get you very far in terms of prior down periods. So for instance, the global financial crisis bear market, was like 17 months, give or take. And that almost kind of outdoes most of the companies, most of the sectors on the list. So the importance of having a long runway to ensure that you can get through these periods of downturn is very important, and that's, I'd like to say, an SVB strong suit where we can help advise our clients on that runway extension and managing cash. And finally, once again, more proprietary information from SVB, and this demonstrates a trend that was already happening, and you might have heard the phrase path to profitability. So if we look at like EBITDA margins for cohorts of companies, you can see over time they're negative, but they're trending up, which is that path to profitability. More notably, that spread is narrowing, and in 2020, it's obviously the narrowest. And once again, with the current situation we're in, we expect companies to conserve more cash and cut expenses and look to become self-sustaining, which of course means you're entering profitability, or at least break even. We're seeing that in the data. That was pre-COVID, and we expect that to really accelerate now in the period we're in. One thing that is interesting is the ability to raise funds. And obviously most of us, including this call today, is done remote. We don't get to meet people as much anymore. And so whether companies can take new investment or have to rely on existing investors is definitely a question. So 2 things tied to that is inside rounds, so getting funding from the existing pool of investors, also down rounds, which is raising a lower value at a lower valuation from the last valuation. We haven't seen any movement in those 2 things, but I do think that's a data, just a lag in the data rather than a true reality. We're hearing a lot about investors triaging their portfolios, and part of that is deciding to invest more money in companies or not, and that will show up in inside rounds. And then down rounds hasn't moved either. But I will say there has been some notable announcements recently. So Monzo and Lime both announced down rounds. And so we expect this normalization. Valuations were already being run up and we're at a premium, certainly in places like the Bay Area. And so we expect the valuations to normalize. And once that balances, then, and as you can see on the right-hand chart, we expect deal activity to once again uptick, because we'll be in this, balanced supply-demand situation where valuations are once again reasonable, and investors are willing to kind of dive in and deploy record amounts of dry powder. So that's the presentation, and I'm happy to take further questions if people want to send them to me. This report is available online, and there's ways to contact me. So feel free to follow up if there's anything else people would like to know.
Thanks a lot, Nick. Great insights. And again, you can if you just search it online or go to svb.com, you can find our State of Markets report. So thanks for that. And that really sets some good context for our panel discussion with Iris and Steve. And so why don't we dive right in? And if I can ask each of you to, starting with Iris, please, to go ahead and introduce yourselves and your firms.
Yeah, I'm Irish Choi. I'm happy to be here. I'm a partner with Floodgate. Floodgate is a seed stage firm that's based in the Bay Area. And we still very much think of our core product as funding companies that are going from the 0 to 1 phase. That may mean that the company is going straight to A, in which case we would still write them a check, but ideally we would be writing our first check in at the seed stage. We're fairly sector agnostic, and happy to participate in the panel and be able to give some insight as to what it feels like in the current environment, given we do invest so early.
Hi, I'm Steve Schlenker. I'm one of the founding partners of DN Capital. I run our US office. DN Capital is based in London, England, and we mostly help companies bridge across the Atlantic from Europe to the US, US to Europe. We have one company in Brazil called RecargaPay, a large payment company. We do mostly Series A investments. Occasionally we'll invest in the seed round alongside someone like Floodgate if we want access to the A, but we're really a Series A investor. Occasionally we'll do Series Bs as well. About $600 million across our different funds that we have under management. And we do software marketplaces, fintech, and consumer internet. So we avoid things that are a little bit more esoteric.
Thank you both. And Steve, I have some fond recollections of us sitting up in the hills of Rio de Janeiro back in, I think it was 2013 or something like that, at the Santa Teresa Hotel. But anyway, well, thank you both for that. And again, thank you both for joining us today. So I guess piggybacking off of Nick's slides and really sort of looking at the decade of venture in the US and the enormous amounts of capital that were, were invested. And if you think, we've all been through a few cycles, but Steve, you and I were working on a couple projects back in the .com era. And that was the last time that, the amount of venture broke 100 billion. And in the last 2 years, we've had, the all-time high in 2018 of 140 plus billion, and last year at about 136. So I guess maybe Steve, starting with you, what were some of the factors behind, sort of this run up in venture over the decade? And then, sort of one observation is this notion of cycles, and you can argue with COVID, where were we in the cycle? Were we, do you think the bull run would have continued?
Sure. So first, venture in general goes through applied tech and deep tech cycles. And so coming into the 2008 time period, we were starting to go from deep tech into applied tech cycle. And you had the same dynamic that was happening in terms of the overall economy for at least a period of time in 2007-8 that we have right now, in that there's widespread fear and uncertainty about what's going forward. There's a lot of money being pumped in by the governments to try to salvage the economy. And unfortunately, like 2007, 8, 9, what we are seeing is that it's sort of disparate in terms of where that money actually goes. So people who are in the right position are getting a lot of access to those funds, but a lot of people are seeing a much more modest recovery, if at all. And that happened in 2007, 8, 9. So we didn't have a normal recovery like we did in, say, 2000, or we had in the 90s, or in the 80s. What we had was a very muted, long recovery in the overall economy, which meant that we didn't have this big run-up that led to a big decline by its own nature. The only reason we're actually in a recession right now is because of artificial constraints that the governments around the world put on the economies to try to keep people alive. And so we would have had a continued run for a period of time, maybe not for a year or two, but probably for another 2-3 quarters before we would have seen these things falling off. And I think that applies both in the tech world and in the non-tech world. In the tech world, because we're going through this applied technology cycle, there are a lot of new entrants coming into the market, because it's much easier to take technology and apply it into next generation personal transport, companies like Uber and Lyft, next generation e-commerce, like you saw in Europe with Zalando. It was much easier to think through business models. So you had a lot of new entrants because you didn't have to have people who were really deep tech specialists. And that drove a lot of investment 2008 to 18, 2009 to 19, just because it was much easier to understand the business models. I think, Andy, I'll leave it over to Iris because I know we're covering a lot of ground. So I want to give her a fair chance to talk.
Yeah, I mean, I think part of the extended boom is also because there's been so much access to capital at the various stages, especially at the later stages. So there's a natural transition point is, you know, Andy, I was a banker in my prior life before venture. And so this, I know it's something that we're going to cover probably later, and Nick touched upon it in his slides, which is as you prepare to go public, the expectations of public investors are very different than private. And to be frank, probably less forgiving. And we started seeing this even pre-COVID with a pulled IPO for WeWork, where people no longer want to necessarily buy shares in a company that has no path to profitability. They may be willing to extend when they expect to see the first profitable quarter to 2 to 3 years out, but they want to know there's nothing structurally wrong with the business model that won't allow it to become profitable. But when there was so much capital in the private markets, what you saw was companies staying private for longer and not necessarily having that spotlight put on them around their business model when they could become self-sustaining. Because if anything, more people were trying to get more money in. So the concept of self-sustaining, they were willing to push out so they could get more ownership in the meantime. And so that's something that for us at the very early stages of seed, we're very sensitive to, because not only does it mean that our path to liquidity has now become pushed out, maybe even beyond the 10-year fund cycle that we normally sign up for with our LPs, but there's also this expectation that the exits are happening for companies when they're at billions of dollars. So if we want to see liquidity, a lot of times it's very much bifurcated. You know, one thing that we had seen over this past cycle that's different than in prior cycles, even in like 2012, 2013, there was this concept that when you're writing a check in venture, you're really dual tracking the company, right? So there's 2 ways to exit, and primarily, you're either going to go public in an IPO or you're going to sell to another company, most likely strategic. And those used to happen back in like 2012 to 2015, and it could be anything from an acqui-hire, which, you know, Yahoo was famous for doing a lot of, especially post Mercer Meyer taking over, or you could go public. Well, the bar for going public now has become very high, right? There's very few companies that go public at less than $1 billion, but the M&A environment at, let's say, sub 300 million has really kind of dried up. And so you have companies that realize that their own path to be able to go forward is going to take longer, and they're going to be experimenting a lot before they go public to try to see what other product lines, for example, that they'll have. You know, Uber and Lyft didn't go public with just one offering being the peer-to-peer car sharing. Uber especially also went into delivery and geographic expansion. And so I think that's where the access to more capital in the private markets allowed probably for a lot more creation than you may have seen in prior decades. Because again, in prior decades, companies went public primarily because they needed the capital and they couldn't get it in the private markets.
And Andy, just to add what Iris is saying, there are a few other dynamics from the VC standpoint. So post 2008, you had a bunch of changes to how you had to manage your business if you went public, primarily through Sarbanes-Oxley. As a result, it became much less desirable as the entrepreneur to go public, at least until you had significant control systems in place. Alongside that, very expensive and also a big distraction, and also potential liability for the individual. But alongside that, you saw a new innovation that developed, which was the ability to do secondary sales. You know, years ago, it was very uncommon if a later stage VC came in for any of that money to filter out to the early stage VCs. The whole idea was that everyone exited together. But because later stage investors still want to have meaningful stakes as these companies built out, a whole industry developed where someone who wanted to come in at a very big check later on might give some liquidity to someone like Floodgate or someone like DN, who's an early investor. And so it enabled us to have these models where a company could stay private longer, because as the early investor, we didn't have the same pressure to force a company to exit or force a company to IPO, because we get our liquidity through the secondary markets.
So yeah, really interesting how the market began to solve for itself with some of these new products and like secondary funds, et cetera. And certainly one of the benefits to entrepreneurs, as you said, Steve, is you know, why go public and you know, pay the costs and get the analyst scrutiny when you don't have to, if you can raise at good valuations in the private markets. So you know, I want to move on here to a slightly different topic, which is, you know, as Nick pointed out in his presentation, you had this notion of really supersized rounds coming together. I mean, I think we all went through the period where people were joking around, hey, the seed is the new Series A, so on and so forth. You know, you had $100 million Series A rounds were not uncommon. Yet at the same time, in Iris, I'm going to ask you this because you're because Floodgate invests at the seed stage. When you look at the really early stage of seed and angel levels, that the number of deals over the last, probably the last 4 or 5 years kept declining every year. Now the check sizes were getting bigger. So what was going on there from an early stage investor perspective? Were seed investors actually taking less risk during the last, even though the dollars are running up?
Yeah, one of the things that I think is interesting, well, there's kind of a couple different angles here. One is that, Nick pointed out that there was a lot of dollars that poured into venture, but what you saw was that a lot of them were actually going towards the later stages. And so you're going to have a lot of now what's known as crossover investors, so traditionally public investors that now have a private arm as well. And so I think there's a couple different things that were happening. You'll know, Andy and Steve, that like over the last couple of years, people love to joke that like anyone can start a seed fund. But what we actually saw was, yes, there were a ton of operators and angels that went out and raised an institutional fund, and now we're technically competing with Floodgate. But the number of firms that could actually lead a seed round were still pretty much the core group that had been around for the past decade. And so maybe those smaller funds were now becoming part of the syndicate. And that's not to say that they won't grow into becoming leads as well, but that's not necessarily where a lot of the action was. A lot of the competition for seed, to be frank, was coming from the Series A and later investors that are now multi-stage, right? And it's exactly what Steve had mentioned, that he may only write a couple of seed bets, but it's usually about trying to make sure they can either keep tabs on the company or get allocation for their core product being A or later. And that's where we saw a lot of the competition. And that competition a lot of times manifested itself in saying, why raise a seed round if you can raise an A, right? And from the founder's perspective, if they're dealing with venture capitalists who may be a little bit valuation insensitive because they're used to seeing Series A prices versus seed, and they can raise a bigger round without having to take on disproportionate dilution, I can understand the temptation from their perspective to say, that's fine, I'll skip seed. Instead of raising a 3 to 5 million seed round, I'm going to go ahead and take a $10 million seed check, and now I've bought myself a lot more time. So I think it was less about seed investors weren't willing to write the checks. I suspect we were actually writing the same number of checks as we have in the past, but more of our pool was now getting hijacked, to be frank, by the direct to Series A firms instead.
Steve, do you have a counterpoint being a and B investor here?
not as much a counterpoint because, of course, we love firms like Iris's. You and I both know Felder Hardiman, one of the legends in our industry, and he used to tell me that venture capital was about 3 things: selection, governance, and anointment. And people talk about selection and governance, but anointment is basically when a firm with a reputation sprinkles their favoritism on a specific startup. And when you have a firm like Floodgate come in, a lot of other seed investors want to come around Floodgate. When a firm like DN in Europe gets a deal, then other people want to come around us. In the US, when someone like Sequoia or Benchmark or firms with brand names come in. But if you don't have that anchor firm that provides that anointment, then you have a lot of people just shy away and they drift off. So even though there are a lot of people who want to participate in the early rounds, like you mentioned, if they don't have that person holding the flag or holding the scepter that anoints the firm, they're not going to write the check. And that goes to Iris's point that the number of deals probably hasn't gone up, or maybe it's gone down slightly, even though you now have a lot of these new entrants.
Great. Well, I think Felder is a very extravagant guy, so I appreciate that analogy, and I think it also goes to Nick's comment in terms of the experience of the investors, and so sorry, that's my dog. The experience of the investors does matter, right? So firms like Floodgate, firms like DN Capital have been around, whether it's in, sort of more run-up times or certainly in more challenging times, I think there is experience does matter. So I want to leave some time here. There is a lot we want to cover. So let's move on. And let's talk about the impact of COVID. Obviously, we've had a decade of really amazing growth in the venture industry that's come to a screeching halt, as Nick points out. We're in a bear market now, and want to ask each of you, if I can start with Iris, in terms of what are the top 2 things that you're telling your entrepreneurs in terms of how do you navigate COVID?
Yeah, so I think similar to a lot of venture firms in the early days of sheltering in place, we were spending a lot of time on Zooms or phone calls with our founders, trying to make sure they could extend their runway. And for us, it was a couple different reasons why we were focused on that. Part of it is that we are very early at seed, and we also tend to prefer capital efficient companies. And so they're not the ones that are necessarily raising a $10 million round if they can get it, but rather we hold their feet to the fire a little bit by the round size so that they are forced to run experiments in a very efficient manner. But unfortunately, what that means is in a time like now, where I would argue very few new checks are actually getting written over Zoom. I think, you've heard a lot of investors from Coastline and Andreessen Horowitz admit that while they look like they've been prolific in writing checks over the last quarter, those were all deals that had high degree of velocity going into sheltering in place. And so I had a couple concerns. I wanted our companies to be able to not only survive, but actually thrive during this period. And it's a shift in mindset, because I feel like over the last 5 years, raising capital was so that you could outspend your competitors. And now we're actually saying the capital you have needs to allow you to outlast your competitors. And so the real battle will happen once we kind of come out of this weird period that we're in. And hopefully you will have shown enough success during this strange period that you can then fundraise coming out of it. But our expectation is that for most of our companies, you're probably not going to be able to fundraise for 2 to 3 years. And so the cash that you have on your balance sheet needs to last you that long, or you need to find a way to monetize other aspects of your product. And you license your technologies and no longer just about selling the core product to be able to buy yourself that much runway. And the 2 to 3 years is not because we're expecting, God willing, that we're sheltering in place for that long, but it's because what we've seen is that in venture, valuation expectations usually lag the public markets, but so even after the public markets start to recover, VCs still expect a COVID discount. And so if you don't want to be raising funding at a, let's say, 40 to 60% discount versus what you think you would have earned in February, then what that means is that you're just going to have to try to be able to last on the capital you already have versus actually going out and fundraising.
So Andy, we're slightly later stage, as you know, than where
Right.
Floodgate plays. So we don't tell them that long a time period. What we typically say is we want you to have optionality. There needs to be at least one plan that you work off of that gives you capital into 2022, which when we were giving this advice principally in March, April, May, was about 21 months. And we said you should have another plan which basically says you have capital to the second half of next year. Even if you thought you had it for a shorter period of time, you need to extend out. And then, so then again, you're looking at more like, 15 months. And then let's see how it plays out if you can rely on your older plan. But you should at least have a 15-month plan and you have a 21-month plan. And then the second thing we've been telling our companies is really bear hug your existing customers. The probability of new customer wins goes down because first, the approval process is much greater. A lot of things that could have been approved at the VP level get approved at the CEO, CFO level for the customers. Just the fact that you have to do customer calls on Zoom instead of in person, a lot of times means the close rates will be less. So make sure you don't have any churn. Make sure that your existing customers love what you're doing, that you listen to them, that you make sure your product features and functions satisfy their current and future requirements so that you create a barrier from competitors trying to attack your customer base.
Yeah. And if I could just add to that, I mean, that's the kind of input that we had received from the Series A firms that we tend to work closely with, because I think from a founder's perspective, if I'm asking them, you're not going to be able to raise, or it's going to be at unattractive terms, so you need to actually use the next couple of years to survive off of what you already have, the natural kind of question becomes, but then you're teaming up to grow into a subpar company, right? If I'm not allowed to invest in marketing or growth. But what we really emphasize is exactly what Steve hit on, which is what's going to be important during this period is not necessarily that you bring in a whole bunch of new customers. That may be nice, but not if they're going to churn. But what's going to be critical is that when everybody else had to cut budget elsewhere, they did not stop subscribing to your software or your solution, right? That you were so mission critical, especially during this period, that customers are actually more loyal to you. Because then, you know, the Series A, Series B firms who are looking to invest will be able to understand in a good environment, they're going to have that many more customers, but not churning the existing customers is mission critical right now.
So that, you know, sort of your comment, both your comments on cash runway are consistent with the data that Nick showed earlier. I thought it was interesting that the median was only 10 months, which seems a little bit light, but probably that probably, you know, falls more because of the later stage companies like Steve is working with. But Iris, let me follow on with you on that thread, which is how do you react through this through the downturn? And I've been asked by entrepreneurs, and I hear answers on both sides, which is, hey, I'm an early stage company, and you know, I'm early in my revenues. Do I pivot now where I can find some revenues? Do I change my business model, or do I stick to my guns and try to, you know, I've conviction in my model. Should I double down and try to fight another day? What do you think?
Yeah, absolutely. And those are all fair questions. And it's interesting because there's a spectrum like with anything else. What I've been really impressed by are our founders who they themselves have realized my core product is no longer relevant or going to thrive in the current environment. And so I need to find a way to either pivot the business very quickly or see again if there's a core asset that I have that can now become front and center in terms of monetization. And so one example I would give is we're investors in a company called Cabin that was basically doing overnight bus trips between LA and San Francisco. That obviously had to be shut down starting in late February. But what they've realized is that they intentionally had created a patented technology that allows you to be able to drive a bus and not have that much vibration so that people could sleep. And they're now trying to license that to long haul trucking companies so that they can do team driving, right? And so now the hope is they still have a larger vision where once quarantine or shelter in place is lifted, they are going to go back to their core business about the long haul bus trips. But in the meantime, this is another product that they've now moved up in the product roadmap to be able to monetize it. There are other companies where we had very different concerns where their core customer base is really suffering because of COVID. And we think it's going to take several years for that customer base to come back. And those are harder in some sense conversations to have because I'm telling a founder who spent 5+ years of their life building a business that they feel passionately about that I don't know that business model is fundable going forward, right? And we talk about it as founders will then go through the various stages of grief, right? Because they have to say goodbye to something that they were building their whole business and life around. But trying to help them understand that it is not our judgment call saying your company is no longer fundable, but we actually will have conversations with the follow-on investors in our ecosystem to say, what would it take for this company to actually secure a Series A or Series B check from you? And what is the likelihood that we can sign up or the founder can to actually delivering against those goals?
Sorry, Andy, I think you might still be on mute, but yeah, I would say in many of our companies, we're advising them to think about what are the features and functions they need to add to their product as opposed to pivot that could take advantage of the changes that are going on with the digital transformation around us, and also that take advantage of the short-term interruptions or disruptions in their models. So for example, we have a company in Germany that does short-term leases or 12 to 24-month leases of office furniture. And we've worked with them to move to doing short-term leases of home office equipment, chairs, tables, computers for the home environment, which has caused them to maintain their revenue line. We have another company in the shipping logistics space where it's still held onto its business, pretty well because of what's going on with warehousing and e-commerce or food e-commerce. But we're advising them, what types of features can you add to your software that deal with how do you manage a warehouse where the employees have to be spaced out? How do you handle the the requirements of proving that you've maintained a hygienic workspace for trucks and for people shipping and otherwise. So we're telling people, think about your product roadmap and what you need to do to add to what you have rather than pivot. Now, clearly, if a company is just in a space that's not going to make it, then you have to have that hard conversation that Iris was talking about. But we tend to gear slightly differently.
So with time getting short, one question from the audience, one more question from me, and then a very short question to end the discussion. But just looking, if you guys can both keep your answers relatively Twitter-like, just in terms of where are you investing now? What sectors are interesting to you, particularly as we look at sort of the new normal?
Yeah, so for us, it was interesting to see, it was also included in Nick's presentation. There's a lot of talk around, oh, recessions are a great time for founders to get started. And it's true, but I would argue it's less about the recession, although that does play a role. And it's more about inflection points that were already happening, that happened to coincide with, for example, the financial crisis. And so in 2008, it was really the massive iPhone adoption, the processors were getting faster, et cetera. And we feel like anytime, especially around a crisis, there are naturally more inflection points that are going to happen. And one of them that you mentioned was telemedicine, right? Out of necessity, they started easing state regulation so that you could actually have video calls between doctors and patients across state lines. And now the question becomes, post-COVID, will they ease those restrictions or will they reinstate those restrictions? So we feel like there's going to be a lot of change around remote communication / consultation that could be very interesting. The other part where we're spending a lot of time is this concept that social contracts between employees and employers have been disrupted. And so we've been seeing it for a while, that the concept that someone goes and works for a company after college or after high school and then they expect to spend their entire career there is no longer kind of the going in assumption. But especially with the gig economy having taken off the way that it did, we're looking to take that a step further, which is it's not necessarily about working for a gig platform, but actually becoming a solopreneur. So there's obviously an industry like Intuit that really supports SMBs. Well, what if it's not a less than 10 employee business? What if it's just your own business and it's just about you? What kind of CRM systems do you need there? What kind of marketing tools? And so that's where we've been spending a lot of our time.
Yeah.
Great.
In our case, what the shelter-in-place conditions have indicated is that people are really ready to accept digital transformation. And it's been forced upon all of us, but I think we've realized for the most part that being able to buy things online instead of in person, be able to do financial transactions online instead of going to your bank, all these things are not just something we're forced to do, but something that's actually a better experience. So we're looking at what are the laggard industries that still have a lot of transactions taking place without doing them online, and what platforms and software can you do to help those industries be able to respond so that they maintain their revenues in an environment where people are going to increasingly rely on digital transformation. Second to that, we're believers that we're going to go to a different wave than we had after 2008, where because home ownership got hit so bad because of the financial tinkerings on Wall Street, that people moved into not ownership, into renting models, into shared economy models. We actually think that as a result of what's happening now, where people can work remotely, that they're going to increase home ownership. They're going to say, I'm going to be able to now afford to be an hour from my office instead of having to get a cramped apartment that's right near public transport. And that will drive both, not just home ownership, but all of the fintech opportunities around that space. And then finally, I think we think that the operators, with their big push to 5G between now and 3 to 5 years from now, are going to try competing with Amazon, Google, and Microsoft for cloud services. And so they're going to have a lot of requirements to how do they build out a mobile cloud, and whether that's software for them, whether that's services, whether that's new applications. We think that's going to be a big push over the next 3 to 5 years as well.
Great, thank you. I'll try to answer the audience's question which was posed. Do you guys invest in Brazil? And I think not regularly, opportunistically. Steve has in Iris. I know Floodgate's in Rappi, a terrific company. So, but I don't think it's your usual business as usual type of investment. And so let's wrap up again as time runs out here. Just a quick scale of 1 to 10. How bullish are you in terms of the investment opportunity as we look out in the next 5 years? Steve, why don't we go with you?
Oh, 10, absolutely, without a doubt. And I should just add before we break that Silicon Valley Bank has been phenomenal in this crisis in terms of helping portfolio companies extend their debt positions, in terms of being able to extend new forms of credit. It helped a lot of my portfolio companies. So they've been a big supporter. So I just want to throw that out there. I've been really pleased with our relationship with SVB, but overall, absolutely a 10.
I will say, especially in these types of moments, it is incredibly helpful to bank with someone who understands the startup ecosystem, right? And because it's going to be very different than if you're with a commercial bank who's used to working with either just individuals or much bigger companies. So I would echo Steve's comments about the level of support that we've received from SVB, both at the fund level as well as the portfolio company level, which has been fantastic. And I would also agree, especially to be an early stage investor, you kind of always have to think it's a 10, right? You have to be an eternal optimist, because the reality is, statistically speaking, 90% plus of companies probably won't have a successful exit. And so we do what we do because we believe every company that we meet has the chance to try to become one of the few that goes on to become a unicorn. Or we joke, we will be in your corner, whether it's helping you shut down the company or hopefully more likely, ringing the New York Stock Exchange bell with you on the day of your IPO. And so that's our level of commitment. But our hope is every year, despite the environment, that it should be a 10.
Terrific. Lots of optimism to end out the U.S. side. Iris and Steve, you're both great partners, and appreciate you joining us today and spending some time. So thank you both.
Great. I need to run, but thank you again, Marguerite, for including us. It was really fun. Thank you, Andy.
Thank you so much, Iris.
Thank you.
Thank you, Steve. And thanks, Andy. So before
back to you, Marguerite.
For those of you joining us now at Facebook, welcome to our conference number 9. We just finished the US Focus panel. And before we start the Brazil panel, we want to bring back some more music for you. With us, Daniel Dalarossa, Brazilian entrepreneur, who will play Chorinho for us. Hi, Daniel.
Hello, Margarese. Can you hear me fine?
Very good.
Okay, so I'm going to play now this composer here. He's still alive. He lives in Rio. He's a mandolin player. And we just announced his book. And the name of the show is actually a machixe. It's a cousin from Choro. It's called Tres Amigos, 3 Friends. Let's do it. live. Thank you so much, Margarita.
Thank you so much, Danielle. Thank you.
All right.
I think you opened almost all of our conferences so far. I think Danielle is mute. Okay, obrigada. Thank you, Danielle.
All right, thank you, Margarita. No, I'm sorry, I thought the question was for another person. Wonderful, I was following, and I have some questions later. I will ask Andy about how is Silicon Valley funds doing, but congratulations, wonderful as always. Thank you so much, Margarita.
Obrigada, Danielle. Success to ChoroMusic.com.
Thank you. All the best, Margarita. Bye.
Thank you, those joining us now. We are shifting focus now to Brazil with a very special group of guests. I would like to call Andy Tsao again to present them and lead this panel. Andy Tsao is with you. How are you now inspired to discuss the Brazilian market, huh?
Oh yeah, now we're moving into Brazil, and we have some great speakers with us today. So really looking forward to it. And what will start this hour of the BayBrazil event is with a little bit of reflection in terms of our experience, my experience at Silicon Valley Bank, and our time in our journey in Brazil, which again has been since 2012, and so not quite a decade, but getting pretty close now. And when I think back, our journey there started in March of 2012. That was our first trip, and we took our CEO Greg Becker. We took a number of investors with us, and I met, I think, everybody here on the panel today in that very first trip. So it's been really quite an amazing journey. And been a privilege to really be part of how the ecosystem has developed and matured over nearly a decade. And today we work with more than 600 clients across the region. About half of that is in Brazil. So let me share a screen with you. See that. Okay, so at the risk of sounding like someone's uncle who's going to take you through a slideshow, and we don't have time for that, I thought it would be fun just to pull a few pictures out. Obviously, BayBrazil has been a big part of that journey. Margarita, I think that was from the Stanford conference in 2014. That might have been my second conference, and I joined the board shortly thereafter.
2014.
Of course, there are far too many pictures in my camera roll of caipirinhas, so that was a theme. Eric, that picture of you in the top with Michael Nicolas and Fabrizio Blasi and CK, that's LAVCA 2014 in Sao Paulo. And cheating here a little bit, Nicolas, this was the Argentina Venture Capital Forum. I think that was 2014 or 15 also. Anderson, that was not in Sao Paulo either. That was in the Embarcadero in San Francisco, having some fun at a Endeavor event, sharing some cooking. So it's been really a fantastic journey for Silicon Valley Bank. So let me go to some data here. Let's see if I can. Sorry about that. Okay, so let me set the stage for our conversation here. And this is LAVCA data, although I've kind of doctored it up a little bit. Obviously, the thing that jumps out at you, and this is similar to our U.S. discussion, is the amount of capital that has been invested and how much that's grown since over the course of the decade. In this case, this slide shows 2011 to 2019. So not quite a decade, but pretty close. And what I tried to do here is also use this as sort of a timeline. So if you look, again, back when Silicon Valley Bank started our first trip, and we attended the Founders Forum, which oddly enough, Steve Schlenker was part of in our first panel in the 2014 version of that, 2013 version. But in that 2012 version, I met Anderson, who was I think, Anderson, you guys were just launching Redpoint around the Founders Forum. I think you were a sponsor of that conference, if I remember correctly.
That's correct. That's precise.
Nicolas and Hernan were just off of launching their fund at the end of 2011. Eric, he's one of the early veterans of the industry, where monashees got started way back in 2006. But obviously, if you look at that today, that was really sort of the starting point of this generation of venture capital, from my view. Another significant event I put on the timeline was the founding of New Bank in 2013, and that's Nicolas. You guys are in New Bank, of course, and meeting David Velez when I was disappointed to hear he was leaving Sequoia, but more than happy to be their bank when they needed banking for New Bank, a new venture he was launching that year. Fast forward to 2018, you had the first unicorns that hit the scene. 99, that's one of Eric's companies, of course, that was acquired, that ultimately was acquired by Didi at $1 billion valuation. New Bank hit unicorn status that same year, and then 2015, I think I think the headline. 2019. The headline is safe to say it was really the launch of the SoftBank LatAm fund. So not only did they announce a $5 billion fund, but they put an awful lot of money to work, and you could see the $4.6 billion that was invested that year. And just another interesting statistic that I tried to put here is in those circles at the bottom. If you just looked at those couple of funds back in 2012, if I pooled them together, the kind of dry powder, if you will, collectively was about $300 million back in 2012. And now you fast forward to where we are today in 2020, when you look at the new funds that the guys have raised, plus all the other, doesn't count any of the other funds out there today. And then you add in a SoftBank, of course, you have $6.3 billion of potential dry powder, a 20-fold increase from back in when I first started back in 2012. So quite an amazing growth of venture capital in the region. Another busy slide, sorry, but what I tried to do here was just to compare sort of what was happening in the startup ecosystem in Brazil, and sort of overlay what was happening in the Brazilian economy at the same time. So again, when we got to Brazil in 2012, it was, if you remember, Brazil had kind of a nice run up under Lula. 2012, it kind of flattened and things started to decline from an economic perspective. Yet in that time, 99 was founded in 2012. New Bank and Logi in 2013. And then you see the depths of the recession here when the impeachment of Dilma, Rappi was formed. Very interesting, and so on and so forth. But the other thing I'm trying to illustrate in this slide is the time that it took for these companies to hit unicorn status and beyond. And so, and what you see is an acceleration happening here. So, the early ones that I mentioned, again, 99, New Bank, Logi, kind of 5-6 years it took for them to hit unicorn status. But look at Rappi, 4 years. New Bank, interestingly enough, after they reached unicorn, the very next year, in 2019, they raised a funding round that multiplied their valuation. They were, a multi-corn, I guess you would call it. And that only took a year. And again, if you look at Loft as an interesting example, they were formed in 2018 and hit unicorn status only 2 years later. So again, a shortening of the time frame for these companies. And so what I see, the velocity of the ecosystem in Brazil really beginning to accelerate. So this slide, just another Lavka slide, just shows the regionalization of venture capital. And what I wanted to point out is two interesting trends here. So one is, that while Brazil has always been the biggest hub within Latin America, there's no question that it's regionalizing more. And so if you look at this square here, where per Lavka data, if you look at the 2011 to 2015 timeframe, Brazil accounted for 64% of the dollars in Latin America. Well, last year it was down to almost 45%. And look, by contrast, in Colombia, now it's a little bit skewed because of Rappi, but back in that 2011 to 15 timeframe, it's 3.3%. Last year is 20%. So if you look at any of the regions, you see the same sort of trend happening. And then lastly, when you look at where are these guys, my friends here on the panel, investing, and put you on the spot a little bit. When I came down in 2012, if I'd asked you where you're investing, no question, Eric and Anderson would have said, hey, our edge is in Brazil. This is where we understand. So we're really investing in Brazil. Nico, you guys were investing out of Buenos Aires, even though Brazil is your biggest market. But even so, you're kind of Brazil centric at that time. And look at today, if you look at, Kaszek and monashees in Mexico, in Colombia, with Redpoint as well. So just the regionalization in terms of where the investor community is investing as well. It's been another really interesting trend to see. And so again, just summarizing, there's a lot more venture capital and dry powder in the region over the last decade. We talked about the acceleration of the velocity of the funding and how quickly the valuations are growing. The regionalization of the venture capital industry, the creation of a lot of valuable companies. And we didn't really talk too much about exits except for 99, but there were some nice, examples of Brazilian companies that went public on the U.S. exchanges as well. And that, of course, that was all pre-COVID. So I think as we look out on 2020 and beyond, we're kind of in a different scene now, but we could talk about that a little bit with the guys. So with that, I think I'm going to have one more slide, which is, again, just while I'm not Brazilian, as Marguerite refers to me as BayBrazilian, it's a country and the region has become very near and dear to me, and it's become a really nice business for Silicon Valley Bank. We've met great partners and clients and friends along the way. Folks like Brian Reckwarth. There was a nice dinner with Team Monashees. The founding team of Guiaboso, David Velez. We have Manuel Lemos and then Nicolas, you and Hernan doing a BayBrazil event. That was fun as well. So it's been a great journey, and I do need to thank my team, and that's the big picture in the middle. They're the folks that support our ability to do business in the region and make sure that we can serve our clients there. And I want to highlight Julia Figueiredo, who's on my right in the picture, who's our current director of Latin America. And Julia's doing a wonderful job with our Brazil and Latin America business. And of course, she's Brasileira and from Belo Horizonte. So thank you for all you do, Julia. So with that, I think we can move into the panel discussion. Let me stop my sharing. Here we go. Anderson, Eric, Nicolas, welcome. Thank you so much for joining us today. BayBrazil's 10th year anniversary, and this is part of the sort of the series that will make up the Brazil annual conference that you guys have all spoken at in the fall, typically speaking. But obviously we're doing things a little bit differently this year with not being able to get together in person. So welcome to you all, and maybe again we're short on time, so I think, as I said before, on the U.S. side, anybody that follows Latin American venture capital, you guys don't need any introduction. So why don't we just skip over the introductions and move right into the discussion. Again, we're looking at venture capital happening in Brazil over the span of the decade. We'll talk about sort of obviously the impact of COVID and kind of where do we go from here. Anderson, why don't we start with you, my friend, and I'd love for you to talk about your reflections on, you're a veteran in the industry too, when you're investing out in Naspers, and you backed your partner now, Romero Rodriguez, and How have you seen entrepreneurs involved over the decade in Brazil? The quality of the entrepreneurs.
Fantastic. So good afternoon, everyone. Great pleasure to be here for multiple reasons, but the most important of them is my role as a board member of BayBrazil. So Andy, thank you so much for the work today, for handling all the MC today, and congratulations, Margarese, for the fantastic job you have been doing. I'm watching it for the last 8 years of the 10, and it's fantastic how much it evolved in the last few years, especially. To your question, Andy, I think there was a massive change in the ecosystem, as your numbers showed. I didn't realize, frankly, until you put it in that format. But today we have more unicorns than we have funds 8 years ago in your graph, which is very telling. I remember probably with Nico and Eric here. Hi guys, great pleasure to be here with you. Discussing not long ago with the whole industry in Brazil was $500 million or $1 billion, and today we have such a setup. So it's very, very interesting. Specifically about the entrepreneurs, the number obviously it's a lot more. We saw exponential increase in the number of entrepreneurs. I think there was the passion and the drive is the same. The biggest quality, actually it's something we see in Latin America and everywhere. It's common to all entrepreneurs, which is the passion to solve a big problem. But I think in our region, we started to see entrepreneurs that have more in-depth knowledge of their own industries, the industries that they are going to disrupt or try to disrupt, but also about venture capital itself. It was very common for us to start a meeting with an entrepreneur and have to recommend them some really venture deals or something, so that we could have a fair discussion with them. And today it's a level playing field. So I think the quality, the raw quality is the same. The quantity increased a lot, and the knowledge improved dramatically in the last few years.
And I remember, as a contrast to back in 2011, 12, you had all the sort of newly minted MBAs, you had all the folks, entrepreneurs are coming from other parts of the world to launch businesses. It looks quite different today, doesn't it?
Absolutely. What we do miss, we had a very nice wave of foreign entrepreneurs coming to Brazil. I think that was very, very positive. It's less so today, certainly not compared to the numbers we have. That's the one part that I personally, I think we could do better as a nation to attract more entrepreneurs. But all the rest, as you mentioned, now we have entrepreneurs with 7-10 years of expertise in their fields, and also the quality of the team underneath the founding team improved a lot as well. So it's a lot easier to attract top talent today than it was 10 years ago.
Right, for sure. Eric, maybe turning to you, again, you gosh, 2005, that goes well beyond a decade. So congratulations to you and monashees as well. So as you look at the growth of venture, and as I try to point out in my slide showing GDP, like all these companies like Nubank and Logi, they all thrived despite the terrible macros in Brazil at that time. So how do you look at that, Eric, in terms of is there any sort of linkages between the macros and startups in Brazil? How do you see that from your perspective at monashees?
Sure. Thank you, Andy. First, before I answer your question, just wanted to say, congratulations to Margarese and the whole BayBrazil team. I mean, incredible work. We've been, good friends, since you started, and it's amazing what you have built. And of course, Andy also in Silicon Valley Bank, and Julia. I mean, a pleasure to work together. I always remember that first meeting in 2012. with all of us here, and starting to, to try to build that industry. It's great to see the numbers that you laid out in your slides. And it's great to be here. Also a pleasure to share this panel with friends, Anderson and Nicolas. So to answer your question, I mean, we started in 2005, as you mentioned. So we like to say, we started to run, the marathon. We started the marathon 5 miles before the starting line. So, but in a way, that's why we're here today. We had some time to try to learn, and we saw actually 3 very distinct phases until we got to the GDP recession phase that you showed. The first 5 years there was nothing in the market, nothing really happened, so we had to wait until the market took off. Then between 2010 and 15, the market really took off. Brazil grew, GDP was growing and attracted the foreign entrepreneurs that Anderson mentioned. But actually what happened, those 5 years, there was early stage capital available. There was a reasonable early stage, starting to happen, but there was not growth capital, not enough growth capital to really help these companies accelerate. So this really happened after 2015. The real heroes were the entrepreneurs that in those years, built great companies without access to really good growth capital, like 99 or Viva Real with Brian, or Nubank with David. I mean, this is incredible. It took a little longer for these companies to really take off because there was not a lot of growth capital, but they did a great job. And the maturing of those companies actually helped attract growth capital since 2015-16. And that capital was attracted by these companies that were showing that, hey, it's possible to build multi-billion-dollar companies in Latin America, but also the availability of capital, globally, the interest rates, dropping. All this combination of factors just allowed us, in the last 5 years, to attract great global investors, not only SoftBank recently, but, in those years, DST or even Sequoia and recent GIC, they all started to invest. And it happened independently and completely independently from the GDP growth in Brazil, because actually that's the nature, the VC investors have learned over decades that there's no correlation between GDP growth and VC returns or the opportunity to create companies. Actually, some of the best vintages may happen, during those recession years. So that's something that just made the industry continue to grow. Just to summarize and to finalize my kind of long answer, sorry about that. What happens here is that, recessions affect traditional companies, because traditional companies in traditional markets, they need GDP to grow, or they need to gain market share to grow. New companies that are offering new products, tech-enabled products, new experiences, or innovation, disruption, they are actually looking at consumers and attracting consumers and users and customers that are looking for those products online or tech-enabled that are actually coming from these traditional industries. So you have a lot of market to attack when you're innovating. So that's why it's not related, in my opinion.
For sure, and as you say, Nubank attracted that capital. You said in 2015. Again, if you think of that slide, that was in the depths of the recession. So really, it looks pretty uncorrelated from that perspective.
Sorry, just to complement the Rappi and Loft that you mentioned, they had a shorter cycle because they had access to the growth capital since 2015.
Fair point. I do want to. You reminded me when I showed that picture of Lavka. I didn't mean to say that when you hosted us in your office back in 2012, it was like one of the first times we convened the venture capital ecosystem, and you're like, oh, why don't we do this more often? So it was fun to be at that meeting as well. Nicolas, over to you. And Eric started to talk a little bit about the availability of capital. And again, when I think back on 10 years ago, not only just in amounts, but the availability of funding at different stages was much more sparse. How did you see the availability of capital, not only in total, but in stages? And are there still any gaps today as we look forward?
Yeah. No, so first, like everybody else, thanks for having me here and diving into the question. 10 years ago, definitely everything in the ecosystem looked very, very different. First, as Anderson described, there were fewer high potential startups compared to now to start with, but particularly on capital, the market was much more embryonic than just a gap in one segment. I would say that capital availability overall was the gap a decade ago in 2010, 11. There were basically no sources of funding for startups except for some exceptions. It was really hard to access capital. So building a company in those days required some mix of bootstrapping, financial discipline with very controlled burn, some friends and family money, angels, some local institutional PE type of capital that typically came with terms that misaligned incentives. And then for some of the more mature companies that had managed to survive the dot-com crash from 2000 and by 2010 had scaled, there were a few US growth funds, maybe like the Tiger Globals or the GAs that were investing in Brazil, but very, very scarce. As you know, we had IPO'd Mercado Libre in 2007. At the time, we thought that the availability of capital would accelerate in the following years. That did not happen, probably because the ecosystem was still not deep enough. And for sure, the global financial crisis in 2008, 2009 did not help. So that's the past. You fast forward to today, and the current capital availability scenario, as Eric was saying, is truly extraordinary. A good founding team today has no excuse whatsoever. There's abundance of high quality angels that many times includes successful entrepreneurs that are investing back in the ecosystem. There are many local accelerator and incubator programs that do a very good job. The international programs like YC or IndieBio have been accepting an increasing number of LatAm companies into their programs. There are dedicated seed funds, etc. And then, of course, you have very consolidated funds like the ones that are represented here in this call and many others that lead early stage rounds and have collectively funded hundreds of startups. So I also agree with the comments from before. What has really changed materially in the last couple of years, this has been happening, what I described over time, but in the last couple of years, what has really changed is the access to these larger rounds. We became used to seeing many 50, 100, $200 million rounds happening. There was a consistently and gradually increase, but this really accelerated in 2018, 2019 with SoftBank, but many others also that have been in the market and really became to be comfortable deploying those types of checks once they saw that there were opportunities there for those checks to go to. And we saw many rounds at those sizes. So you were asking about gaps. I think the good news is that we do not see anymore any fundamental gap in the market like we would have seen years ago. Maybe if you force the question and if I had to identify a relatively weaker link in the ecosystem, I would say it is mostly in the 30 million or so check size. Funds like us can stretch up and maybe lead around at those sizes, or a growth equity fund can adjust downwards and maybe also lead around, but it is probably the segment of the value chain with the least presence of dedicated funds.
It's such a luxury to be able to answer that question in that way today, Nicolas. I remember for years everybody was complaining about the lack of kind of, that Series B, C, funding round, and congratulations to all of you for all closing funds, within the last year or two, and specifically, some capital available for funding growth in different opportunities on that front as well. So you're absolutely right, Nico. A lot fewer gaps today. let's see. Yeah, again, you touched upon it. Eric did too on international players. And it's been really interesting with Brazil because we cover some other markets and many of them don't play out in the same way. But the U.S. investors, global investors, have always played that sort of growth stage funding in a relatively significant way. And what's as you interact, whether the players change. When I first started coming down, it was Tsao and Kevin Afusi, and Inside Out of New York was down there at the time. But today you got DST, you have SoftBank, and others, and so the names change, but they're still there. What maybe Anderson, just starting with you, what do you think got these international VCs over the hump? Obviously, you're connected very closely to one of the Valley-based firms here, Redpoint.
Absolutely. So I think that there are very different types of investors and interest in the region. I think you mentioned some that have been, although not based here, but with a long-term investment strategy for the region. I think obviously Redpoint and Eventures that are our partners, they have been committed for a long time. I think Kevin that you mentioned, it's a great example as well. Spends time literally on the ground here to develop a good understanding of the region and the culture and the people. Tiger has been with different intensity, but around the area for a long time. But I think a lot of the new names are parts of the maturing of the ecosystem in our view. So part of what Nico very properly described. So as the companies were, the best performing companies were maturing, we started to attract initially growth capital on a global platform. So it was a harder time for the entrepreneurs for sure. Now we start to have local funds. I think Kaszek was a pioneer in that with their later stage funds. I think we'll start to see that more and more. And I think growth capital with a foothold here in the region will be very valuable as well. But I think Brazil entered the global scene of investing for different reasons. I think around when we raised our bigger rounds, we, Redpoint, Eric with monashees and Kaszek as well, around 2012, 13, when we started to see funds above $100 million. Those, to some extent, were long-term investors, but interested in the macro thesis of Brazil, that Brazil was a mini China, GDP was growing. There was a diversification strategy for the limited partners that started to come to the region. As we entered our local crisis here on the macro side, and the startups completely ignored that and became very nice outcomes for the investors. I think we started to attract a different type of investor, both investor in our funds and co-investor in the startups that started to understand more the digital opportunity in the region, which is we have a large enough economy regionally with a lot of opportunities that are clearly going to be digital and that are not there yet. So it's a perfect setup for a long-term investor, which is, in the time horizon that we do, I think it's very hard not to agree that the large companies in the region, Brazil and rest of Latin America, I can't tell you if it's in 3, 5, or 7 years, but in the next 10 years, most of them will be either fully digital or with a very strong technological angle. So the opportunity became first clearer, I think, for investors. And then we had something that was a missing link for the ecosystem here, which was having availability of capital. Are Latin America entrepreneurs going to build big companies or not? We had a very few exceptions. Mercado Libre was clearly one of them, but there was always this doubt that entrepreneurs in Latin America, when they can have a exit at 100, 150 million dollars, are they going to sell or not? And we saw very clearly recently that having availability of capital, these guys really want to build lasting companies that are here to change not only our region but the world. And I think this is what global investors are after as well. So I think we had pioneers that made a bet largely in the company, in the country, and now we have investors looking at the digital opportunity and selected entrepreneurs specifically.
Right. Yeah. Like Andreessen would be a good example of that. Right. Recently, just the last couple of years, just got sort of suddenly doing deals across the region. Nicolas, maybe if I can ask you, and also let's start to weave a little bit of the impact of COVID into the discussion now. Nico, I guess just looking back, not only a decade's a long time to cover, but when you look at there's capital obviously coming in to fund the companies, but you guys are also fundraising, and you've all raised money internationally from U.S. and international investors. How's that conversation developed over the years in terms of their appetite for Brazil, and how do you think that's changed now that we've hit COVID? If I can ask you, Nico.
Yeah, no, for sure. So in terms of LPs, we think COVID is a short-term headwind for everyone around the world. It created some concerns, but it has made it even more evident that software is hitting the world, if I may use that phrase, and is accelerating the shift to digital. So it will definitely generate tailwinds for the years to come in the tech industry. We're fortunate that our key LPs are foundations, endowments. They have a very long-term view. And if anything has changed, it has been for the positive. They have a very strategic perspective. They understand that it is in these times of crisis that paradigms will shift. This is the times where great entrepreneurs will identify opportunities and will create value. So overall, they have been very, very supportive. They have a lot of historical experience, and they understand that these are the right times to be deploying capital and creating value. And they see the same in Brazil as they would see anywhere else. It's interesting because we have some LPs with great experience, with very relevant exposure in the industry globally. So we also try to make always the communications with them go both ways, as it is always very insightful, not only to for them to hear from us, but it is very relevant also for us to hear from them, given that they have a wider perspective from different geographies and different segments and different industries.
Does the exchange rate come up in conversation?
It doesn't come up at all. These are, and whenever somebody has any question about the macro or politics, I think we very rapidly shift from there to secular trends and long-term investments and the way in which value is being created through disrupting industries, creating new industries. So of course, tactically, if you're gonna have a big exit right now, it's not the ideal time, but it might be a good time to be deploying funds that are quoted in dollars. So these exchange rates, they come and go. It's a pendulum. And I think the smart long-term investors really get that, understand that. And the good news about venture is that the capital gets multiplied several times. In other industries, where maybe you produce a 1.5x return, then exchange rates can become very tricky, very relevant. But here it's longer term, it's higher multiples. So it is really not an irrelevant part of the conversation.
Well, and fair enough. I just, from my own personal lens, when I met you guys back in 2012, I remembered how expensive Sao Paulo was. It was at 1.8, you know, and now when it got to 6, I was like, oh my gosh! And of course,
it was
like, other ironies.
It was 1.5, but who remembers? But I think
like other ironies in life, I can't come down to enjoy it. You know, there we go.
But I think we've all been around for way too long to know that these are cycles and things come back and go.
Sure.
At the end of the day, it's about the fundamental value that these entrepreneurs are creating.
Absolutely, Eric. Monashees has been, a pioneer, and you guys have early and often invested with international investors, and so sort of combining both the question for with both Anderson and Nico, just in terms of what's your sense today of where co-investors are? I mean, you guys are looking at deals now. You're talking to, the Andreessens, the GAs, the SoftBanks. Are they standing on the sideline, or are they ready to deploy capital, and are they ready to co-invest with you guys?
It's a good question. Almost, it's hard to tell. It's early. But before I answer that, just wanted to mention, I think we were talking about exchange rate. I just want to say there's a famous quote in Brazil that says, God created the exchange rate to humiliate economists, because it's just impossible to predict what's going to happen.
Right.
And what Nico said, it's long-term, high multiples. We're more protected than average from those discussions. But in terms of the effect of COVID on growth capital, I just saw this number. We tried to track this. There is, of course, a big drop in the first half of the year so far compared to last year in capital invested in the region. But I mean, that's natural. We're in the middle of this unprecedented crisis. So I think all investors are also taking a bit of time to understand and the uncertainties. But the conversations we have with co-investors, and we have co-invested with a lot of, or with many of the international investors for several years, they continue to be very interested. So there is one thing that doesn't change. It's a little bit like premium real estate. Premium real estate doesn't have a volatility. There's always demand for it. So the very best companies, I mean, they are all having conversations, and we all know that this crisis also has a side of accelerating the digitalization. This big social experiment of work from home is just creating, so many tailwinds and opportunities for tech that around the world, and it's not an exception in Brazil. So the really, really sophisticated investors, they are even more excited. But I think right now, in the last couple of months, of course, everybody's really trying to find out what's going on. But in terms of interest, not only the investors that are more familiar with the region continue to talk to companies and to discuss, the next round, we have new investors looking at the region, like Co2 or Lightspeed and some others, just to name a few investors that are new to the region, but they're very interested in learning and looking at opportunities. So I think there will be a little bit of a gap, or a temporary gap now, because of, everybody's kind of, also trying to understand the real impact. But the appetite, as we said, the best companies in the region were built during the worst recession in the history of Brazil. Of course, this is an unprecedented crisis. It's special. It's a human tragedy, and we have to be aware of that. Not trying to say it's. I mean, it's. We have to find a solution, and it's a lot of uncertainty. But we believe that in a few months, I mean, we should just go back to a more normal stage, and for that premium real estate, the very best companies, it will continue to happen. Just to complement, if there is another positive effect, I think with this time, is that the last couple of years there was a lot of hype. So the hype ended up attracting a lot of entrepreneurs and investors that were not really long-term and authentic in their intentions. They just wanted to participate in the party and FOMO driven. And I think the crisis is going to differentiate, the real, authentic, long-term, resilient entrepreneurs and investors. And I think there's a positive aspect to it.
It'll be interesting to see how it develops. Gosh, I could talk all day with you guys, but of course we're starting to get a little bit short on time already. Let's keep it going. And as we get into COVID, Anderson, if I can ask you to start compressing your answers just a little bit, what's the top advice you're giving to portfolio companies right now to get to the other side of COVID?
Well, a very short version is the same as I think most investors, which is shift a little bit from concern about growth into survival. So what happened very clearly is that the value of being alive as a company, from 2 years later, it's huge, and the cost of a mistake between now and that time frame is very expensive. So one way we talk to the portfolio all the time is make sure you can make repeatable mistakes now. So it's a time of uncertainty. See if you can make the mistake many times instead of once. And preserving cash is the best example of that. So if you hold a little bit too much on growth and you are wrong, you have another shot to resume. But if you run out of cash, it's one mistake. So that's short version would be that.
Great. Well, if you missed the beginning, the advice on the U.S. side, Iris from Floodgate said 36 months. You had 18 months from Steve, and then the SV data said the median was 10 months. So kind of interesting. Let's see. Nico, over to you, just in terms of in this environment, are you looking at new deals? And if so, what's an example of something you like?
Yeah, so we're fully back to our steady state of something like maybe 50% of our time on portfolio management and 50% on investments. For March, during March, April, it was clearly 100% working with the companies, with the portfolio, making sure that everybody was going to be in good shape. So we were spending time talking to opportunities. An example, a very concrete one is we announced a couple of days ago an investment in a company called Remessa in Brazil. It was a round of more than 100 million reais that we led. Very excited with this opportunity. They are a fintech that provides international payment solutions, cross-border infrastructure. We also announced a few days ago Belvo, which is a company doing open banking in Mexico. So fully active and looking at opportunities.
Fantastic. And fintech comes to the fore again and as usual. Eric, over to you in terms of maybe just some observations on how you are helping the monashees portfolio in terms of community, and how are you helping the founders, communicate and again sort of get through the crisis together?
Sure, it's a great question. We've always had, very kind of a strong focus on the community activities, as you know. I mean, the international trips and events. Now, of course, we do a lot of more virtual gatherings. We have. It's interesting to note that we've always had a lot of activity in promoting this communication among founders in the community, and I think the crisis just took it to another level. I think founders they need more today of that, of those conversations with other founders. I mean, that's what we've seen. I mean, the level of activity in some of our forums and online communities just went up in terms of the exchange of information and how to deal with the crisis, different aspects. So we are experimenting, we're promoting, we're creating different groups or interest-specific groups. We have, of course, our founders major group, and we're trying to do some partnerships and bring more different type of content. And so there's lots of initiatives, but also a reaction to this observation that, I mean, I think there's even more need today for these founders to interact, share knowledge, and have a sense of belonging in a time like this. I think it's very important.
Yeah, it's been really remarkable seeing, and it's not just in Brazil. I've seen it in India. I've seen it in other markets how, you know, platforms like Zoom have the ability to communicate, to share information, to, you know, and there are no boundaries, right? You can speak to Europe, you can speak to the U.S., Asia, and this information sharing, I think, will really help us all hopefully get through this, you know, faster than we ordinarily would have otherwise. But so I guess as we kind of round out the conversation, let me just check on questions from the audience here. Okay, you know, I think we someone mentioned it along the way, but historically, particularly for strong funds like yourselves, like now is the period of time where history would say anyway that you're going to generate potentially some of your best returns. So as you're looking at investing and you're looking at your portfolio companies, how do you feel about that statement? Are you able to kind of keep that conviction, or are you a little bit nervous in this environment? Who wants to take that? Well, you could all take a crack at it if you'd like.
As bullish as ever. This is a really hard year on many levels, but we're investing today for the next decade, and everything that we see makes us even more optimists than ever before.
Fantastic.
Well, on our end, yeah, sorry, just on our end, I mean, we also continue to be very active. We had like four term sheets signed before the crisis. That we made all the investments. Now I think the big hurdle these days is that, you know, the deal flow is very strong. Lots of very interesting companies, and we continue with our pace. But for the first time now, we talked to a few companies that we haven't met with founders in person, or we haven't had a chance to visit them because we haven't had a chance to travel and visit them. So I mean, it's very different from before. You just meet, have several meetings in person, you travel, you go, and now there's lots of Zoom calls. So it's a different dynamic. I think that changes a bit. You know, the whole kind of, you know, relationship building with founders. That's an interesting angle to it.
That's a whole nother can of worms. Can you do due diligence over Zoom, right? But
we haven't invested in, of course, so far in this new kind of post COVID kind of deal flow.
Yeah. From our end, Andy, it's very much aligned with what Nico just said. It's the opportunity just became much more obvious than it was before. So I think our work as managers is going to be easier long term. The opportunity, it's more tangible for the average person everywhere, in our region in particular. And we are extremely bullish. We think what was a probably biased vision that we had at Redpoint, that the opportunity in the future was going to be huge, that just became much more obvious, and it moved from a nice opportunity to more of a mission. It's pretty clear that there will be a lot of rebuilding after this, you know, unique crisis that we are going through. It's going to take a while until we rebuild, but I think it's very obvious that the companies that will lead the way and run all these reconstruction are precisely the type of companies that all of us here, you know, look for and try to support as well as we can. So we are incredibly positive about the future.
Fantastic. And as I did with the last panel, if you can each give me just a number from 1 to 10 in terms of where you rate your optimism for the next 5 years in venture in Brazil.
That's an easy one. You're going to have consensus. I think it's a 10.
11.
Yeah.
Eric has to be different. 10 as well. All right. Well, we have 10s in the U.S., 10 in Brazil. A lot of optimism to end the conversation. Anderson, Eric, Nicolas, thank you very much for joining today. It's been a great discussion. Again, I could talk all day with you guys, but we're about out of time, so I'm going to turn it back to Margareth.
Thank you so much. I love the optimism and I love to see you guys. Muito obrigada. It's amazing to have you here at our opening event. This will be a weekly event live every Thursday with a different topic. So thank you so much, dear speakers. It's amazing to see you again. It is amazing to see this optimism. And for those of you who join us both at Zoom and Facebook, muito obrigada. Welcome to our number 9 conference. I want to tell you what is coming up in the following weeks. So some of our guests here mentioned Brian Ricord of Viva Real. Brian will be leading next week's session on the future of real estate. With us will be Matt Penks, founder of Loft, and Jonathan McNaught, founder of House. And that's next Thursday. And then we follow with the future of fintech. And we will have David Velez of Nubank and Henrique Dubugras of Brex. That's July 2nd. And then on July 9, we'll have a discussion moderated by our board member, Daniela Jorge, on the role of design on tech innovation. Muito obrigada. It's amazing to have you here to help me kick off the annual conference. Obrigada. Tchau.
Thank you very much. Bye-bye.
Thank you. Um abraço, pessoal. Thank you, Andy.